Hello, good evening, and a very warm welcome to the next session of the Powerhouse Series BFSI. In the last session, we ran out of time and we couldn't take any questions from the participants. So I did request that in the chat box, and I'm repeating it now again. If you guys have any question from the previous session, please type in the chat box so we can answer the question. Do mention that the question is from the previous webinar. If it is from the current webinar, you don't need to mention it in that case. So the today's topic is around the management accounting part of the financial services, and we have with us our MNP Vice Chair, a fellow ACCA member, Mr. Tahir Sarj from National Bank of Pakistan. So while you guys are typing in your questions in the chat box, I'll hand over to Mr. Tahir, so he may formally kick off the session. So do type in your questions if your question wasn't answered in the last session. So over to you, Tahir.
Thank you so much, Feroz. Thank you so much. Okay, Assalamu alaikum everyone, and let's begin the session of management accounting. Sorry, I did not get that point. Are we taking the questions right now for the last session, or are we taking it at the end?
I think we don't have any question. It is 4 minutes past 6, so we'll just request them to type in their questions and we'll cater them at the end.
Okay, fine, fair. But I believe that I think I'll be able to complete this session at 7:30. So I'll spare 30 minutes for that, or 20 minutes for the Q&A session. So you can, I mean, you can ask them to ask as many questions as they want.
Sure. So guys, I hope you heard Tahir Saab. So please type in your questions if you have any regarding the accounting portion of the financial services or the management accounting portion of the financial services. So over to you, Tahir Saab.
Okay. Assalamu alaikum once again. Today I'm conducting the next session of the accounting part, and that is actually a management accounting session. Before moving on to the slides, let me brief you what is financial accounting part and what is a management accounting part. Well, financial accounting part is something that we have already covered in the last session, right? In which we were regulatory bound to issue the financial statement to the stakeholders. And the stakeholders include your shareholder, your investors, your different peer banks, and to the general public and to the government as well. So there are a number of stakeholders of the banking, and for that we have a specified format to prepare the financial statement, right? There's a specific format on which all the banking industry is supposed to prepare their financial statement, and they have to do the annual audit on that as well, so that a reliance can place on them. But when we talk about the management accounting part, so management accounting is not at all something which is a standardized thing, and that standardization, since this is not a standardization, so it can be for anything. I mean, analysis for the sake of analysis can be done for anything. Like, for example, we can do the analysis of the income side, we can do the analysis of the expense side the bank is bearing, and we can do the analysis of the interest expense side, we can do the analysis of the admin expense side, we can do the analysis of borrowers, we can do the analysis of our depositor, we can do the analysis of our investment portfolio, we can do the analysis of the yields being the return, right? We can do the analysis of the top borrower, top depositor, top investment holder, top NPL, that is a non-performing loan. We can do whatever we want when we are talking about the management accounting side, because management accounting means something on which you want to apprise your senior management about the figures, right, about the data. So it can be for anything, and most of the data include in this analysis is the internal data, right, as well as the external data. It also includes the internal data as well, because it's not necessary that all the information given or all the information of the management accounting is published in the financial statement. So there are so many data which are the internal documents and which are the internal data and which actually derives from the source documents of the bank, right? So we need to understand that management accounting is not a circle bounded something, right? We need to understand this thing, that it can be for anything. I mean, you can analyze your capital adequacy ratios as well. You can analyze the impacts on the capital adequacy ratios as well, which is a compulsory ratio. It is regulated by State Bank of Pakistan. You have to maintain it, right? So it can be for anything. It can be for anything, right? So I can do even the peer bank analysis. I can do the peer bank analysis of income. I can do the peer bank analysis of the expense side. I can do the peer bank analysis of the net interest margin, that is NIM. I can do the peer bank analysis of our admin expense. Or I can do the peer bank analysis of depositor advances, NPL, number of employees. So it can be done for the financial side as well as the non-financial side. Okay, so this is very, very important that we should understand what is management accounting. Well, the basic thing that we as an ACCA have learned in our academics is the ratio, right? That's a basic thing, right? Well, management accounting core analysis is also based on these ratios, right? So you are actually supposed to do trend analysis. You are actually supposed to do ratio analysis. This could include your NIM analysis, which is a gross profit margin in trading or in manufacturing companies. We can do net profit margin analysis. We can do operating profit margin analysis, the trend analysis over the period of years, the trend analysis over the period of quarters, the trend analysis with the peer banks, the trend analysis with one department of one organization with another department of the same organization, or with the other organization. So management accounting is not it's a limitless thing, right? We cannot say that this is a management accounting area, this is not a management accounting area. Management accounting is not a limited area, right? So at any point of time, at any day, anyone can ask you anything about that. We have to do the analysis of this thing. Okay, so now I hope that I'm giving you the flavor that what we are going to start today, right? It will not be a big analysis, but we can do analysis on our own strength or our requirement desired by the senior management, but it's a limitless thing. So since we are talking about the analysis of management accounting analysis of a bank, so let's start with the income side, right? That is markup, return, or interest earned on your loans and advances portfolio. Well, we can have three kinds of any bank has three kinds of products, right? And they have different names for that product, right? Naturally, if we talk about the nature of the products, so in most of the cases, our products are basically based on three things on which the bank are earning their interest or return. One is demand finance. Demand finance is basically a long-term finance. It has a tenure of more than 12 months, right? Cash finance is less than 12 months, and running finance, right? Sorry about that running spell. Running finance is for working capital financing, right? Or we can say cash finance and running finance, they both are basically the same thing, but in some banks they are calling it as cash financing, and in some banks they are called as running finance, right? But running finance is something which is also called as overdraft, right? So from company point of view, what we call it as overdraft, because it's a less than 12 months requirement.
Sorry to interrupt you. I forgot that I haven't given you the presenter rights. Do you want to share your presentation with us?
I am already sharing a presentation.
No, we cannot see your presentation.
Oh.
Can you reshare?
Oh, okay. No, it's. Can you see it now?
Yes, we can.
Okay. Sorry, I didn't know that I was actually, but since it's the first one, that was initial one, and now this is the first one. So we have not lost so many things.
That's fine.
This is slide
Keep
number
it.
1 actually. Okay. Okay. So what we can analyze in terms of income on loans and advances. You see, we can divide the income that we have earned in that period. This period could be a quarter period, it could be a sorry, 6 months period, it could be a 12 months period, and that divided by with the average volume. Average volume means your average balances over the period, right? And that could be a opening plus closing divided by 2. This could be a quarter balances, that could be a month-wise balances, this could be a week-wise balances, but ideally this has to be a daily balance, right? Now, because of the system um, installed by the banks, now they are in a position to drive the average volume on daily basis, right? And this is the best way. This is one of the best way to calculate the yield. For example, if 100 is the income and 1000 is the average balance, so 10% would be the yield. Yield is income divided by average volume. So 10% will be the yield that we are getting on our demand finance. Now, look at this. For example, if I'm giving you the yield, and that yield is actually comprising over the period of months or over quarters. So we can easily identify that how much yield we are earning, how much yield a bank is earning on their demand finance, right? So a demand finance, I mean, how can we compare it now? Since it's a percentage. So this percentage, for example, it's a 31st December percentage, 31st December 2021. So we can compare it with 2020, we can compare it with 2019, we can compare it. I mean, we can make a trend of that of the last 5 years. Okay, so a trend analysis would enable us that are we generating adequate yield from our demand finance or not. Okay, so if we want to increase a yield, so we have to ensure that either our interest rate should be increased or the volume of the product should be increased. You see, so like for example, in consumer products, there are a number of customers. Like for example, we have gold products, we have a number of retail products like car financing, like credit card financing, like number of other financing. Like for corporates, we are for commercial we are giving financing, for corporate we are giving financing, for SME we are giving financing. So for example, if we have extended them the demand finance, so on the basis of demand finance, we can identify the yield that we are earning, right? So you see, a demand finance can also be break down into multiple things. For example, this demand finance has given to a SME. Is it given to a corporate entity? Is it given to a commercial entity? Or is it given to an overseas company? I mean, overseas operations, because banks are having their overseas operations as well. So you see, I hope you all are getting what I'm trying to say. So we can bifurcate the demand finance with the subcategories as well. You see, what would that enable us? Definitely, this would enable us to see the trend, how much yield an individual sector means corporate, commercial, SME, consumer, commodity, staff financing, how much that sector is actually giving you. So we can concentrate on which area we should make money. You see, so a demand finance can also be further sub-bifurcated into multiple segments. Now let's move on to the cash finance. Well, for cash finance, again, income divided by average volume will give us a yield, right? And now, for example, if a finance is booked on 31st of December on the last day, so it will be included in the average volume, yes. But if you will do an average of opening plus closing divided by 2, so that, for example, if it's a 1000 figure, for example, if it's a 1000 figure and you are averaging out on the basis of opening and closing, that is 0 for the opening and 1000 for the closing. So average of 500 will come, right? But against that, do you believe that in that calendar year, which is a banking year end, which is a banking year end, will you be able to earn any income? No. The income that you are actually earning will be just for one day, and you are booking the average volume on the last day. So the yield will not be a good one. So the yield will not be a good yield. Definitely the average volume. So that's why we are saying that we have to use the average of daily averages. We have to pick daily averages so that we can easily we can dilute the impact of this opening and closing. If you will divide the average volume on the basis of 365 and you will use just for one day, so 1000 divided by 365 will not be a material amount. It will be just 3. And against that, for example, the income would be 0.5 or 0.2. So that will not be a big, error for this yield. But if you are doing the volume on the basis of opening plus closing divided by 2, then the average or the average yield will be distorted. Okay. So this is the yield, and this is one of the most important area for any bank to analyze, because bank this is the income area, right? This is the income area, right? So if you have any income related issue, so definitely you will analyze all the incomes in this way. You see, I have given you a nature of the product, that is demand finance, cash finance, or running finance. The point is what banks are doing, they are bifurcating this thing on the basis of their products. One is corporate product. No, I'm saying that they are doing it on the basis of product wise as well, because they have multiple products in their retail. They have multiple products in their agriculture. They have multiple products in their SME financing. Okay, they have multiple products in their gold loan as well. So they are what they are doing. They are actually calculating the yield on the basis of their products, and that analysis will enable them to identify which product is giving us good yield, which product is giving us not a good yield. Okay, which product should continue, which product should not continue, on which product we should concentrate, on which product we can okay with it. We are okay with it. Okay, so the point is, this is a very important area for the sake of your income analysis, right? Then this yield analysis can also be done on the basis of geographical as well. Now, how come it's a geographical? For example, am I extending the retail side in Sindh? Am I extending the loans to Punjab? Am I extended the loan to KPK? Am I extending the loan to Balochistan? You see, these kind of analysis can also be done, because there are, for example, for agri, let's talk about agri. This Punjab belt is a wonderful one, and the southern Punjab, and specifically that southern Punjab and some part of the Sindh, definitely the bank must concentrate on that front as well, that where we should concentrate, right? Because what about the fertility rate? Is it, I mean, should we concentrate on the Punjab side? Should we concentrate on the Sindh side? Should we concentrate on the KPK side? Where should we do that, right? Then even in that, where we should extend the nature of the product. For example, it could be for commodity. I mean, let's talk about a commodity or agree. Can we do it? What's our return in terms of a cotton? Are we extending this loan for the cotton? Are we extending this loan for the sugarcane? Are we extending this loan for the wheat? Are we extending this loan for some other fertilizer? You see, so sorry, for some other crop. So even banks are doing this kind of analysis, because you see, the future is all about data. If you have data, you are king. If you have the data, you can do the decision making. If you have the data, you can take the better decision where you want to go. Okay, so the point is, the yield should be on the basis of the product wise, right? Okay, so these kind of in-depth analysis we can do, right? Now, let me tell you one more thing. A management accounting site is also famous, or is also adoptable in the business groups as well. Now, banks are even taking finance people in their business groups, so that they can give a good decision-making guideline. They can give a good business analytics area, so that they can take decisions whether they want to go for this product or not. Now the model is changing. The model is actually based on, we should hire our own finance, right? Own finance people. We want to do these kind of analysis on our own, so that we can have the idea that where should we heading towards. We put our resources of the bank. So I mean, the banks are now even concentrating on that thing. So that's why I'm saying that it's a wonderful analysis, and definitely the data is the key resource. And if you have good data, then only then you will be able to calculate the yield. Okay, the next thing is investment, right? um, the second most important, or the more one of the good return, the bank on the thing on which the bank are earning their return, is the investment area. Bank can make their investment in T-bills, they can make their investment in PIBs, they can make their investment in Sukuk, they can also make their investment in foreign government security, TFCs, Sukuk, PPTFC, that is participation term finance certificate. So there will be a number of line items on which a bank can do, and shares can be ordinary shares, it could be a preference share, it could be a listed preference, it could be an unlisted preference, it could be a listed ordinary, it could be unlisted ordinary. Now, what bank will expect from a management account side? Definitely, they will ask the management accountant to calculate the income, and they will also ask the bank, the management accountant, to calculate the volume. Again, you should have to have the average balances on daily basis, so that we will be able to calculate the accurate yield, right? And uh, definitely the product which would be earning the highest one will be the preferred invested area, and bank really want to go for that tenure. Like for example, in T-bills, PIBs, the government is paying really good, and it's a risk-free area, because there is a zero rate of default, because government is basically sovereign, right? So the government is actually it's a risk-free area. So banks are, I mean, from the last couple of years, the banks are actually investing too much into the T-bill and PIB, because through this they are also actually funding the bank, the government of Pakistan as well. So these are the two scripts of the federal government, and definitely the banks are earning good amount of money. So that's why. So what our management accounting side role is, we have to calculate the yield, right? On shares, the income side is very good, right? Because there are number of shares which are paying really good. So if you analyze the income side, so you will find out that shares are very good return. Shares gives very good kind of a return, but on the other side, shares are a bit risky as well because of the macroeconomic factor. Um, Definitely, the T-bill and PIB will not be hurt because of that. Because if you are booking your income, or if you are taking T-bills or PIB on one rate, so definitely you will get the yield on that, unless and until the market value of discount rate will go up and down. So that will lead to the unrealized gain or unrealized loss kind of a thing. For example, if you book a T-bill on, let's suppose, 14%, and if the discount rate is 16%, so definitely you will have to book the losses on that. This is a situation that banks are actually encountering these days, and this is really one of the biggest challenges for the banking industry. Again, it's an Islamic instrument. Sukuk is an Islamic instrument, and banks are earning on that script as well. Then we have foreign government securities, in which I already briefed you in the last session. We can have GOP foreign currency bond, we can have foreign government securities, we can have number of things. Then we can have TFCs. TFCs include your listed TFCs. It could also include your unlisted TFCs. You see, so these are the line items. Now look at the income of each one of them and calculate the average volume, and then you will be able to get the yield, right? Yields are the returns, right? So returns, the maximum return that you are getting, or that you will be getting on on which products, so you will get the preference on that. Sorry. Can I get a, sorry, just a second. I'm sorry. Sorry for the trouble. Okay, so this is the analysis that we can do for investment side, and those banks who are actually investing out of Pakistan as well, they can do the analysis on their foreign securities as well, and they can compare them with their local securities as well. So domestic and foreign comparison can also be done in terms of yield. But in most of the cases, let me very frankly tell you, in foreign securities, the return is not that much as compared to our domestic investment. Domestic return is really good. Firoz, am I audible?
Yes, you are.
Okay, thank you. Okay, then we can have, sorry. Okay, then we can have one more income that is balanced with other banks. If we are keeping a balance with, in terms of placements, in terms of current account placements out of Pakistan, so we can earn the investment we can earn the investment on that, right? It's not a big portion, but definitely you can get the income, you can get the average yield, average volume, and you get the yield as well, right? Then we can have reverse repo. Reverse repo is a lending to financial institution, right? So on lending to financial institution, again, the income can be divided by the average volume, and you can get the yield, right? Reverse repo is something on which banks are now concentrating a lot, and we can also have a product. I mean, we can have call borrowing as a borrowing, which is a part of lending to financial institution. We can have reverse repo. We can have buy module with us, right? Buy module is something which is a Islamic instrument, and buy module can be done with the State Bank of Pakistan. Buy module can also be done with the other than State Bank of Pakistan as well. This is the product on which the banks are also earning the yield, right? So this is one area on which banks are also our bank also earn their income, right? But definitely the volume is not that much, right? So that's all about the income side. That is loan and advances, investment, and balance with other banks. And there would be other things as well, but most of the time the income analysis is something which we normally do on these kind of areas, right? Okay, now let's move on to the expense side. Well, similarly, we can also analyze our expenses on the same formula, on the same pattern. We can also divide our expenses with the average volume that we are having on that we are getting on deposit sides. Well, banks has multiple deposits. Like we can have call deposit, we can have saving deposit. Call is kind of a fixed. The nature of the call deposit is fixed, right? Call deposit is an instrument that we can give, we can issue to a party, to a depositor, right? And we have to pay the interest on that as well. But it's an on-call deposit, right? So they can call it at any point of time. Saving is something we already know. It's a saving account deposit, and banks are supposed to pay the expenses on that, right? And the rate of saving account is based on the discount rate the government is actually setting. And the third product is the fixed or term deposit, right? So a term deposit product can also be a special term deposit, right? Like for example, there are a number of banks which are offering special rates to their customers to get the deposits, and there are a number of TDR which has been issued normal rate, on normal TDR rate, right? Then there are a number of products of TDR. For example, there could be a 1 month TDR, there could be a 3 month TDR, there could be a 6 months TDR, there could be a year TDR, then 2 years, then 5 years, then 10 years, then 20 years. So a TDR products are bifurcated on the basis of their tenure, right? It can also be bifurcated on the basis of their volume, that is value. For example, if you are ready to invest, for example, 10 million, and the tenure is, for example, for 1 month, so definitely the bank will the bank can offer you a good rate. So they have their schedule of I mean, they also have their schedule on the basis of tenure as well. So this is not just for the sake of tenure, it is also for the sake of volume as well, right? So TDR product is very, I mean, detailed product. It's very happening kind of a product, and there are a number of banks who are getting good amount of volume on that. But definitely they have to pay the expenses as well. And the average cost of the bank, you see, did you all notice that the current account is not here? Because current account has no interest. So we are not supposed to analyze it, right? Well, in terms of average cost of the bank, it will have a very good impact because it reduces the impact average cost of the bank, and because it has no cost. That's why bank always asks you to open a current account, right? Because it's a free source of free cost of deposit, right? And that free cost of deposit is, and the bank is earning, for example, 14%, 15%, or 16% on that, and even more on that, right? So bank will be happy to have a current account with you, right? They can, I mean, they would love to have a current account, because on that their spread will be the income side, right? What is spread? Spread is basically income, that is yield that we are getting on these products, that is loan and advances, investment, balance of the banks, and reverse repo, the total of that. And if we are deducting the average cost on that, then we will get the spread, right? Well, the spread will also include other things as well, but I'm giving you an overview on that. Now, what banks do? They can bifurcate the TDR, that is term deposit, sector-wise, how much your companies are taking the TDRs. Because, for example, if OGDC is coming, a PSO is coming, PPL is coming, and they're asking you to give a good amount, good rate on the deposit. So definitely the average cost would be high, right? Because at times bank has to meet their target by paying a very high cost on the TDR. But saving definitely, on the other hand, is something which is normally dependent on the discount rate, but it's almost very less than the um, discount rate. So what I'm saying is, the bank can do these kind of analysis. They can also bifurcate their TDR products. Their I mean, there could be other products as well. Like, for example, in Islamic side, there could be number of other products. They have different names for their products. So they can analyze that how to get the money in from these channels, right? So they can do the analysis on their products as well. They can do the analysis on their term, on their tenure as well. They can do the analysis on the value as well, that how much they are getting in, for example, 1 million TDR. For example, we have a product of 1 million TDR, we have a product of 10 million TDR, we have a product of 5 million TDR. So how much we are getting in each one of the product, and how much average cost that we have to pay there. So this kind of analysis can be done by the banks, right? And there is a separate department who is working on that. And in 99% cases, the branches are supposed to cater only two areas majorly. One is the deposit side, because this is one big source of funding for the asset side, for the advances side, for the investment side, and for balance with other banks as well. So definitely banks are concentrating on this side, and they always concentrate on low cost of deposit. They want to keep their average cost of deposit at a bare minimum level, so that they can get maximum spread. Okay. So average cost is something uh, which is required, and bank are analyzing their average cost, so that to get the maximum spread, right? Then the second major source of banks are borrowing, right? They can do borrowing from State Bank of Pakistan. They can do a borrowing from State Bank of Pakistan in terms of buy module. They can do the borrowing from against their buy module. They can take it from the other financial institution as well. So definitely, if they'll take a borrow. They'll borrow from State Bank of Pakistan for their export financing, for their different other, like consumer financing, for their agriculture related financing. So they have to pay a cost. So if they will pay the cost, so we can calculate the average cost on the basis of average volume. And as I already told you, that average should ideally be on the basis of daily basis, right? And but if there is a limitation with the data, so we can take the average volume on weekly and monthly or quarterly basis as well. But this has to be on daily basis, right? To give a good and clear picture. Okay. Then we have a repo. Sorry, this is not reverse repo, it's a repo. Reverse repo is lending. Repo is our borrowing. So we can do a repo borrowing as well. Well, repo borrowing is part of the borrowing, right? In which banks are borrowing from other banks, and this repo is one of the significant line item of any balance sheet, and that repo is actually so we can do the analysis on repo borrowing as well. How much interest we are paying, what is volume, and what is the average cost on that, right? So repo borrowing can also be analyzed that how much interest cost we are paying, I mean how much cost we are paying, and how much average income or income we are earning on the income side. So repo is something that banks are doing. It's a core function of the treasury, right? And banks are doing this kind of work. So what being a management accounting, what is my job? My job is to do the analysis. How come? Take the interest that you're paying. Sorry, take the interest that you're paying. For example, 50 is the interest that you're paying, and 1,000 is the cost. So you will divide it and you will calculate the average cost. Whatever is the average cost, you have to use it for taking the decision whether you should go for it or not. Okay. The next thing is the non-markup income, right? Non-markup income could include number of services that the bank is giving. For example, there could be a fee for number of services that the bank is giving. There could be a commission charges for services that the bank is giving. For example, National Bank, NIB Bank, and few other banks, they are catering one of the major portfolio for the government pensioners, right? And definitely we are charging something for that. We are charging we are charging fee for the license, armed licenses, for different licenses, motor vehicle licenses. We can have passport fee. We can have for example, if a National Bank booth is there or a Habib Bank booth is operating in Pakistan Railway, so definitely they will charge a fee. So this kind of services are actually not free. They are making money for the bank, right? But they are not your interest income. They are not your markup income. They are non-interest or non-markup income. Okay, so they are non-interest and non-markup income, right? This is one of the core area in which banks are concentrating and banks are making money, right? Because you have your branches around the around the country and you have, for example, there are a number of banks who are operating with their branches of 500, 800, 1,000, 1,500. You see, so you have your presence around the country, right? It's a massive network. So the banks are making money for that, right? Banks are trying to evaluate different channels to get to different things that they can do for their customers so that they can earn the money, right? Then dividend income. Well, dividend income is another non-markup income on your shares that you are investing, right? And foreign exchange is another income on which the forex desk operated under or operating under the treasury function that they are doing, right? And forex is one area in which the treasury is performing, and this is one of the core income side of the bank. And definitely we can also have other income as well. We can also have capital gain head as well in this non-markup income. Like for example, like capital gain that is earned on sale of security. It could be a TBPIB, it could be a, you see, interest earned is included here. But if you have already sold the security, so there has to be a capital gain on that. So that capital gain is part of non-markup on non-interest income, right? On which banks are earning, right? So you can have HFT capital gain, we can have AFS capital gain, AFS securities capital gain, right? It can be from T-bill, it can be from PIB, it can be from shares, and things like that. Okay. Then we can have other income. Other income includes your rent from lockers, um, gain and sale of fixed asset, right? So there are a number of line items that we can see in other income. So it can be different for every bank, right? So foreign exchange, other than foreign exchange, we can also have other income as well. Okay. The next head is non-markup on non-interest income. What was markup or interest income? Markup interest expense, that was for deposit, that was for borrowing, and that was for repo, not reversal, repo. Now we have a non-interest or non-markup income. This includes one of the major line item of that is your operating expense. Operating expense includes your rent and taxes, right? It could also include your insurance, utilities, security, repairs, depreciation, log, number of line items. Like for example, entertainment expenses, donation expenses, salaries, one of the major line item. You see, so the core admin expense, this is the operating, and we can also call it as admin expense. So the admin expense or the operating expense is this side. This is one of the challenging area for any bank, right? So the banks are mostly concerned about their expenses, because this is the core area to I mean, if you are going to control it, if you can control your operating expense, then you will be able to get good profit, right? Because this is something which is controllable, which can be controlled, and for that banks are giving budgets for that. Banks are giving targets for that. Banks are actually taking initiatives to reduce that cost. Like for example, solar is an alternate against the electricity. And for example, we are living in Karachi, and the load shedding time is, let's suppose, is 2 hours only. Whereas if we talk about the far-flung areas, the duration of load shedding is very high. So what do we do in that case? We normally use generator for that, but generator has a cost. So definitely banks ask the management accountant that how do we control it, right? Because your job is not just to calculate the expenses. And by the way, again, if we talk about the volume, this volume is not something which is a balance. This volume could be your, for example, against the rent and taxes. For example, if my against my 1200 branches, 900 are on rent, so I would rather divide the rent and taxes with the 900 figure so that I can find out the average rent per branch. You see, so these kind of ratios are something on which the banks are, on which your senior management would be interested to know, right? And a trend of that will give them a good idea whether this cost is rising or declining. Okay. Likewise, for insurance, for example, this is the expense. One thing is that you are comparing your expenses with the previous period. That period could be a quarter, period could be the last year, period could be a budget as well. For example, at the end, my expense actual is 120, and whereas the budget was 100. So 20 would be the deficit. So the bank would, the board or the senior manager would really want to know that why there's a negative. And definitely you can raise a red flag on that this is something which is against the target. So you can do the trend analysis on that. You can also calculate the sub ratios on that, right? For example, utility cost should be allocated on the branches. For branches, it should be allocated on the branches. For head office, it should be allocated on the groups, right? For other different field offices, it should be calculated on their expense should be allocated on them. Okay. So repair and maintenance can be linked with the number of branches or number of well, this can also be bifurcated. Repair and maintenance could be for machinery, it could be a repair and maintenance for vehicles, bank vehicles, it could be for plant, it could be for something else, you see. So we can also bifurcate that thing. So being a management accountant, you would be required to do an in-depth analysis and try to find out the figures, right? And those figures would give you the good idea, or would enable them means enable your senior management to take a decision, what should we do for that, right? And there are a number of line items for operating expense. These are the few examples that I'm giving here, right? But try to find out the ratio on that, right? Try to find out the ratio on that, because if you will be giving a ratio, like for example, rent per branch, taxes per branch or per offices, insurance, for example, we can bifurcate the insurance into different areas. Insurance could be for vehicles, insurance could be for building, insurance could be for branches, insurance could be for cash, insurance could be for against fire, insurance could be against the life insurance cost. So we can bifurcate these heads into multiple heads, and then we can find out what is the average cost. You see, so this is a very bird eye view that I'm giving you. We can do a deep dive on that, right? So being a management accounting, you would be required to do these kind of analysis, right? And likewise for security could be for head office, security could be for field offices, it could be for branches, it could be um, it could be for guest houses, it could be for anything, right? It could be against uh, the senior executives. So we can bifurcate these line items in much more detail, right? And management accountant can do these kind of work, right? You see, what your management is interested in. Your management is interested in to know what we are doing. What is the issue? Which line item is the issue for us? Which line item is stopping us to have good profit? Is it income? Is it expense? Markup expense? Is it non-markup expense? Is it non-markup income? Is it a tax amount? What is that? So they really would like to know. So being a management accounting, you will be responsible for calculating that, right? Then WWF is worker welfare fund is another area, and the bank can analyze that as well, right? Well, this is the P&L area. Well, for P&L, we can also do the analysis of tax. Well, tax could be tax. We can have three kind of tax, as I already told you in last session, that we can have a tax on. We can have current year tax, we can have prior tax, we can have super tax, because banks has super tax as well. So we can have three kind of taxes. Okay. Then after that, after the P&L area, we can do depositor and advances analysis. You see, what management is really interested in to know, what is our top 10 depositors? Who are the top 10 depositors? Who are the top 50 depositors? Who are the top 100 depositors? So that they can work on it. In most of the cases, there are corporate entities who are the top 10, top 15, top 100 depositors. They are the one. They are giving you the deposits. And for big banks, it is in billions. So definitely the bank would give them priority in terms of interest rate, in terms of services, in terms of everything. Definitely the bank would give them the priority, right? So top 10, top 50, top 100, top 200, top 500. You see, banks are having millions of customers. Banks are having millions of customers, right? So they can analyze their depositor in terms of the volume. What is the top 10? What is the top 50? What is the top 100? And not only just that, they can also bifurcate and they can also make the highest cost deposit. For example, the one who is on the top, who's on the top list, is maybe he's a special rate customer, and he's taking 14% with us from us, or he's taking, for example, 15% from us, and we are earning 16% on that. From that money, we are earning, our treasury is earning 16% from that money. So we are actually earning, I mean, so there is a particular committee in the bank with the name of ELCO. ELCO is supposed to do these kind of analysis. How much spread we are earning, whether it's a good customer, should we retain it? For example, he's giving us 80 billion or 50 billion or 10 billion, but he's charging us, or he's asking us to pay 13% on that amount, or 14% on that amount, or 15% on that amount. So our highest interest earned rate is, for example, 16% or 17%. So against that 17, we will be paying 15 to him. So what the bank is earning on that, we are just earning 2%. So would that be a viable decision to continue with this depositor, or we just ask him to let go? We can ask him to find out some other bank for this amount. You see, these kind of analysis, where we have to do the analysis for the sake of interest rate as well. Then we can also do tenure wise analysis, right? This top 10 depositor, for example, we have top 10 depositor with us. So we also would like to know whether it's a TDR customer, whether it's a saving account customer, whether it's a current account customer, who is he, right? And if it is, for example, a TDR customer, what TDR we have booked against him? For example, is it a 1 month TDR, 6 month TDR, 1 year TDR, 2 year TDR, 5 year TDR? For example, it's a 5 year TDR. So we don't have any issue unless and until he has some emergency. So we don't have any issue for the rest of the 5 years. He will be with us for the 5 years. Yes, we have to pay the cost, but he will be with us for the 5 years. So tenure wise analysis can also be done, right? Tenure wise analysis can also be done on depositors, right? So and then we can also do a geographical analysis as well. So where we are getting the high top 50, are we, for example, there are a number of banks whose major customers are private banks, private sector, there are a number of banks whose major customers are government entities, right? There are major customers whose major customers are, for example, individuals. So they always concentrate on their, from the preference point of view, whether they concentrate on small ticket size customer or big size or medium size. So it's all about the bank's strategy on which they do their business. What is their business model, right? So deposit is one um, big area, big area on which your banks are working on, because there is a separate department on that, and this is actually a business side, and branches are asked to do these kind of work so that um, uh, they can bring the money um, for the investment, for the advances, and for other things. And then I already told you all that there's a CRR requirement of 6% as well. So if you have a deposit of, for example, 100, so 94 is available to you, 6% is not available to you, because 6% will be held by the State Bank of Pakistan, and they will ask you to not use it, right? So that if the bank will have any kind of issue, if the bank will have any kind of a problem, if they will have any kind of rainy days, so they can use their own money, right? Okay, then the next thing is your borrower. Give me a second. Give me a minute. Sorry, Firoz, give me a second.
Sure, take your time.
Okay, thank you so much. Firoz, am I audible?
Yes, we can hear you.
Okay, then we can do the same kind of analysis on our borrower. Who is the major customer of our bank, and how much interest he is paying? What is the ticket size? Is he a government entity? Is he a private sector entity? If he is a private sector entity, which sector he is? What is the risk of that sector? You see, what is the credit rating of that sector? Or what is the credit rating of that company? I mean, is it a vulnerable sector, right? Like for example, agri is a working capital sector, right? In most of the cases, agri loans are short-term loans, right? Because there is a seasonal cycle for agri, right? And the seasonal cycle normally starts in somewhere after September, right? And this season goes to like in March, right? So the 6 months are the core agri business cycle. So definitely the bank will have a major non-performing loan in that time, right? But in the rest of the 6 months, the recovery department will do its work, and then they are recovering the amount from the Greek side. So what I'm saying is the banks are doing these kind of analysis, right? So the top 10 borrower should be, I mean, this should we should do the top 10 borrower for corporate separately. For commercial, we have to do it separately. For sector wise, even the bank can also do it separately. What is the top 10 sugar customer? What is the top 10 textile customer? What is the top 10 cement uh, customer? What is the top 10 fertilizer companies? So, and definitely we can also do these kind of analysis on group wise basis as well, because there are multiple groups who are operating, right? So banks are actually concentrating on groups as well, right? The exposure is given on group wise basis as well, right? In PR, we have a separate regulations for group. We have a separate regulations for individual customers, right? And securities requirement as well. So banks are doing these kind of analysis as well. Definitely, these kind of analysis will help the bank to analyze the performance of the entity, and this would also help them to I mean to give them the idea where to invest, which one, to whom to prefer, to whom not to prefer. Okay, so a borrower analysis can be done on that basis. It could be a top 10, it could be top 50, it could be top 100, and it could be on the basis of the interest that we are earning from the customers as well, right? So it could be on the basis of volume, it could be on the basis of interest rate, it could be on the basis of products, it could be on the basis of sector, it could be on the basis of um, the tenure in which we have, for example, we have extended 20 billion to PSO, and that is actually a cash finance. So cash finance means that it's not a demand finance, it's a cash finance, right? So the company can pay the bank, right? And if they pay the bank, definitely there will be no interest income. So from bank point of view, it's I mean, you are actually facilitating the customers, but on the other side, you have to concentrate on the income side as well. So bank will concentrate on that, to whom we have to do. I mean, what should we do with these kind of customers? Okay, so bank do all these kind of analysis before giving the loan. Then we can do the same kind of analysis on NPLs as well. NPLs are basically non-performing loans. These are the bad debts against which we have to make a provision, right? And that bad debt is actually based on that bad debt is basically made on the basis of PR, that is prudential regulations, and we have discussed that thing with detail in the last session as well. We have four kind of categories. We can have OEM, we can have substandard, we can have doubtful, and we can have loss category. So we can have top 10 NPL, we can have top 10 OEM, we can have top 10 substandard, we can have top 10 doubtful, we can have top 10 loss category customers, so that we can take the idea to whom we should concentrate, right? And that should be on the basis of, for example, we can make the age schedule as well for these kind of NPLs, so that we can work on it, right? So So management accounting, can you see what is the role of management accounting? Management accounting role is not just limited to finance function. It can be extended to other functions as well, right? It can, I mean, as I already told you all that now banks are now moving towards a separate management accounting function for each one of the business group, right? And so that they can take rapid decisions, they can take quick, so that the decision making would be quick, and so that the bank would be in a position to concentrate on their core business, right, and make more money. So NPLs is something that we can we can have a top 10 or top 50 or top 100 NPLs, right? Then we can also analyze the sector-wise advances as well, and this sector-wise classification is also part of your financial statement as well. But look at this, it's 19 versus 18. So we can have a quarter basis bifurcation as well. We can have a month-wise bifurcation of this kind of a data, so that we can take the variance where we are actually giving the disbursements, right? This is the credit risk analysis basically. So we can have a bird eye view where our money is actually concentrating, whether it's agri side, whether it's the mining side, whether it's the textile, chemical, cement, sugar, footwear, footwear and leather garments, automobile, electric, construction, power, wholesale and retail trade, export, import. You see, and by the way, this is a very short list. There's a specific list given on the balance on the sector wise bifurcation by State Bank of Pakistan, and that is actually covered by sector wise advances and sector wise deposit. It's a return that is actually required by State Bank of Pakistan on monthly basis, in which they are actually taking the data from all the banking industry, and they are getting the data, and there's no agree there. Agree is one category, and there are multiple line items in the agree, because we can have citrus in category in agree. We can have other than citrus, like forestry, we can have weed, we can have sugarcane, we can have rice. You see, so there are multiple sectors in that. You see, so just look at the level of the information. And then textile is not just textile; it can be textile composite. It can be finishing, dyeing. You see, so textile has so many multiple sectors. So the bank can analyze their advances even to that depth as well, right? And then automobile can also include cars separately. It can also include your motorbikes. It can also include your tractors. You see, so we can have that kind of detail in that. Then for construction, we can have the State Bank list includes commercial and residential separately. That commercial includes flats separately. That commercial includes other than flat, right? And that detail also be bifurcated into less than 250, sorry, less than, I mean 150, 125, 125 to 250, 250 to 850, right? And more than that. You see, so they can do these kind of the State Bank is taking that level information from the banking industry. You see what they are doing, they are taking all this data for the sake of analysis, where our industry is investing, where the banks are giving loans, which sector is giving the highest NPL, which sector, on which sector we have the maximum exposure or maximum provision. Okay, so you can see that the level of information, because the future is all about data. If you have good amount of data, if you have good quality data, then you will be able to take the decision. So the sector-wise analysis was very good area in which the management actually concentrate. Then we can have contingencies and commitment on the same level. You can also bifurcate how much contingencies you are getting in agri, how much contingencies you are getting from companies operating in mining and quarrying, how much contingencies you are getting from textile sector. What is a contingency? Contingency is the contingency can be bifurcated into multiple heads. I mean, how much acceptances you have given there, how much guarantee you have given there, how much performance guarantee you have given there, how much other guarantees you have given there, how much trade business you have done there, how much contract you have done there, whether it's a usage LC, whether it's a whatever is the detailed terms. So you can bifurcate all of them in terms of sector wise. Okay, so this is one detailed information, and because banks are actually giving guarantees, they are into LC business, they are into acceptances business, you see. So banks has a number of products in that, right? So trade function is one of the major function of any bank. So these kind of sector-wise analysis would give them the more detail that where they are actually concentrating, where they are now planning to go. You see, so it's a very good level information, good kind of information that we are concentrating. Okay, then we can have the same sector-wise deposit information as well, and how much you are getting the deposit from the textile, how much you are getting the deposit from the agri, how much you are getting the deposit from the mining sector, how much you are getting the deposit of construction, power, wholesale. You see, so the data of deposit can be bifurcated into this thing as well, right? So this is very good area of information or analysis, right? And deposit is something, as I already told you all, deposit is a major thing for any bank. Deposit is a major thing for any bank, right? Well, then we can have a segment-wise analysis. We can bifurcate the balance sheet and P&L into different segments of the bank. Segment means different business group, right? It can be on geographical basis as well. Like for example, there is a CRBG function in the bank, right, which is a commercial and retail banking group, right? So we can make a P&L of that. We can make a P&L for treasury function as well. We can make a bifurcation of overseas function. We can make a bifurcation of different there are a number of banks in which we have commodity as a separate function, you see, and commercial products are having a separate function. So whatever is the segment retained with the bank can make these kind of bifurcations. Okay, so P&L can be bifurcated on that, and the balance sheet can also be bifurcated segment wise, right? Advances can be bifurcated, investment can be bifurcated, lending can be bifurcated, cash can be bifurcated, borrowing can be bifurcated, deposits can be bifurcated in these kind of segments, right? Definitely there could be number of segments in which number of line items are empty, because for example, if we talk about investment falls under the treasury function. Definitely in that line item, there would be nothing in corporate or in CRBG or in other, I mean, business segments. Okay, by the way, we have to make these segments for business groups only, right? Not for service groups, because service groups are not supposed to earn the money. Like for example, finance function, logistic function, risk management function, any service kind of a group, canteen function, they're not business generating units, right? So definitely expenses should be allocated on the business, maybe on the basis of their revenue, maybe on the basis of their um, maybe some other basis, right? But normally we have to bifurcate the HO cost and the service groups cost on the business side, because businesses are meant to earn the money, right? So we have to allocate all of them, right? So this kind of analysis can be done for current year, for the prior year as well, right? Then we can have geographical segment analysis. For example, you can have Pakistan as a segment, you can have UAE as a segment, then Far East, then Middle East, then US and Canada, UK and Europe as a segment. You see, so and this segmentation can also be created, right? And this is very common disclosure in the banking industry, and you can even see that in any bank, right? So what do we what is the role of management accountant here? What senior management would expect a management or what senior management would expect from the management accountant? Definitely the data accuracy will be expected, and the decision whether we should concentrate on UK and Europe, or whether we should concentrate on Middle East, whether we should concentrate on US and Canada, whether we should concentrate on some ABC other regions as well. So the segmentation gives you the idea where we are actually earning the money. Then we can have maturities. This is the area which is one of the core analysis area for one of the core agenda items for ELCO, because ELCO is a committee, asset liability committee, would be more interested to know what is our maturity, how much, for example, how much investment is maturing in 1 month, how much investment is maturing in 1 to 3 months, how much investment is maturing in 3 to 6 months, how much investment is maturing in 6 to 1 years. Okay, 1 to 2 years, 3 to 3, 3 to 5, 5 to 10, and over 10. You see, so the bank is actually preparing these kind of schedules, um, and this is basically an interest yield analysis, right? For example, how much is the impact of 1% change in investment? How much is the 1% change in advances? How much is the 1% change in deposits? Okay, this is basically for them, right? Definitely for other assets, for cash, it's not a big, I mean, decision making area, right? The major thing that this note is actually concentrating is lending, investment, advances, and deposit, and definitely borrowing. And okay, okay. Well, we can also make maturities for on contractual basis. This is the interest rate maturity, right? We can also have contractual maturity as well. Contractual maturity means the tenure wise. For example, how much is the advances in maturing in 1 month? Well, that one is actually for the yield. How much 1% would affect your investment in 1 month? How much 1% investment would affect your 1 to 3 months maturity level, right? So this is a separate thing. Contractual is something which is actually at maturity, right? How much advances are maturing in 1 month, how much advances are maturing in 1 to 3 months, how much in 3 to 6, how much in 3 to 1 year, how much in 1 year to 2 years, how much in 2 years to 3 years, and things like that. Okay. So this is a very good food for thought or decision making area for the senior management, right? Then we can calculate the ratios, right? This is a random ratios that I took from balance sheet, right? We can have a trend analysis on total asset. We can have a trend analysis on capital and reserves. We can have a trend analysis on deposits, PAT, PBT, and number of other line items of the balance sheet and P&L. Like for example, we can do it for taxes, we can do it for expenses, we can do it for non-funded income, we can do it for borrowing. You see, so we can also do it for lending as well. So a size factor can be analyzed like this, right? Then we can have asset quality ratios. It's asset to equity, right? It should be calculated on percentage basis. Sorry, it should be calculated on times basis. For example, asset is 100 and equity is 10, so the ratio will turn out to be 10 times. Okay. Then we can have NPL to total asset ratio. I mean, against your total asset, how much is your NPL ratio, right? And then we can also have NPL to total advances as well, cross advances. How much is the against the advances portion? How much is your NPL? For example, my advances is 1,000 and NPL is, for example, 200. So 20% is the infection ratio. 20% is the infection ratio. You can see it here. This is the infection ratio. This is one of the major line item, one of the major comparison thing. This is one of the major comparison thing, right? The non-performing loan should be gauged with the gross advances. This is not that meaningful, NPL to total assets, but NPL to gross advances is the major ratio. This is called the infection ratio, and we have to compare our ratio with the peer banks as well, with the industry benchmark. Like for example, NBP is comparing himself with UBL and Habib, right? And number of banks are comparing themselves with their peer banks, right? Then we can have total asset growth rate, how much your asset has grown over the years, right? There are a number of banks who has crossed 1 trillion. There are a number of banks who has crossed 2 trillion. There are a number of banks who has crossed 3 trillions over the years. There are a number of banks who has crossed 5 trillion as well. Then we have investment to deposit ratio, how much you are keeping it. For example, if my deposit is 3,000, I am in investment, I have kept 1,500. So 50% would be the ratio, and definitely investment to total asset would give you another number, right? So investment to deposit, advances to deposit, that is ADR, is another good ratio, right? I think ADR is not here. Yeah, ADR is not here, but ADR is also a good ratio, right? I think this is here. We have this ratio here. Okay, this gross ratio, the gross advances to deposit ratio. This is called ADR. And by the way, there's a state bank requirement as well to maintain. It's an old circular to maintain 70%, but it was back in 2007. But later on, the circulars has amended as well. Recently, a ratio is going on, which is introduced by FBR for the banking industry. For example, if the ADR of a bank is more than 50, so the tax rate would be different. If ADR for bank is less than 50, the tax rate would be different. So ADR is very challenging thing for the banking industry these days. Then we can have earning asset to total asset. What is earning asset? Earning asset should include your investment. Earning asset should include your deposits. Earning asset should also include your lending to FI, and That's it. So three line items should be included in earning asset, right? Then we have NPL coverage ratio, that is provision to NPL. This is one good ratio. Uh, Big banks always try to cover this ratio. They don't mind to keep a provision for something, but it should be covered so that a PL exposure should be covered, right? Then this coverage ratio can also be calculated on specific provision to NPL, right? Then one of the major ratios is CAR. We can have tier 1 capital ratio. This tier 1 capital is rupees in million, but we can have tier 1 ratio, which is second last, right? We can have RWA in value. We can have eligible capital on value. RWA to total asset is one of the ratio, right? I mean, how much against how much asset you are having risk, right? Definitely the RWA, that is risk-weighted asset, should be less and total asset should be high, because there are a number of assets which are actually zero-rated asset, like for example T-bill, PIBs, government guaranteed loans, AAA rated corporate exposures. In most of the cases, they are also on zero rate. Okay, so RWA to total asset is one good ratio. Then we have tier 1 ratio, and there's a minimum regulatory requirement of the tier 1 ratio as well, which is 6%. For DSIB banks, it's more than 6. DSIB banks are domestically important banks, right? Domestic systematically important banks. And there are a number of banks in that. Habib and National Bank is one of them, I believe. UBL is also part of that. I'm not sure on that, but at least HBL and NBP in Pakistan are part of it, right? So their tier 1 ratio requirement is not 6%. Their tier 1 requirement is at least 8.5 or 9%. Then capital adequacy ratio, there is a regulatory requirement on that. It's a major ratio. The trend of the CAR ratio is very important, and trend should be above the minimum regulatory requirement, and it should be good against the peer banks as well, right? Then we have investment or market ratios as well. We can have EPS or diluted EPS with us. We can also calculate PE ratio. We can also calculate price to book value. This is a very good ratio, that is price to book value. How much is your price against your book value? For example, my book value is, let's suppose 50, and the book value is, for example, 100. So I am actually trading at 0.5 of my book value. So what does this ratio shows us? This ratio shows us that the market is not believing on our result. The market is saying that your book value is actually not reflected in the share price. It could be because of the macroeconomic factors. It could be because of the internal issues. For example, there's, the market is not trusting on your books. That's why it's less than 1. If the ratio is less than 1, so this shows that there's a gap between what market is expecting and what you are actually having in terms of your value, right? So book value is what? Book value is your total asset divided by number of shares. Total asset divided by number of shares. So for example, if it is 100 and price is 50, so price, the market is not asked, the stock exchange is not, or the investor is not valuing your share at its, on par, right? Then we can have market value per share. It's a normal market value which is available from the stock exchange. Then we can have breakup value per share. Breakup value per share is breakup value should be calculated from the equity side, and that equity should be put into your surplus, and it can not include your surplus. I mean, it can be calculated with or without surplus, right? So breakup value can be calculated like this, right? Then we have DPS, that is dividend per share. Then we have dividend yield ratio as well. Yield is DPS upon market price per share. DPS upon market price per share. For example, if I have a dividend per share of 2 and the market is, let's suppose, 100, so 2% will be by 2% is the yield that I am actually paying back to the investors. So dividend yield is the actual return earned by the investors, right? And investors are more interested in this ratio, right? Well, then we can have payout ratio as well. Payout is what is payout? DPS upon EPS. For example, DPS. For example, EPS is, let's suppose, 100, and DPS is, for example, 10. So the ratio would be 10%. That is, you have paid 10% from your earning. Okay, so that is, you have paid 10% from your earning. So payout ratio is very, very important, right? And then we can have sorry, that's earning yield. Sorry. The dividend payout is DPS divided by your par value of the shares, right? For example, if your par value is 10 and you have paid 7 as a dividend, so 70% would be the payout ratio. Okay, then we can have cash dividend. Cash dividend can also be calculated in terms of ratio, right? And then we can have liquidity ratios. Liquidity ratio is something that we can calculate by dividing cross advances with the deposit, right? Then we can have net advances to deposit ratio, right? We can calculate both of them, gross advance to deposit and then net advances to deposit, right? So the higher it is, the better it is, right? Then we can have net loan to total asset, right? Okay, so net loan to total asset means advances to total asset, right? Then we can have then we can also calculate net loan to total deposit, but that deposit should also include your deposit and borrowing as well, because bank is actually using their deposits and borrowing to pay out their I mean, to extend their loans and to make investments. Okay, then we can have LCR, that is liquidity coverage ratio. It's again a liquidity ratios, and we can also have net stable funding ratio, NSFR, right? We can also have CASA ratio. CASA is current account saving account against the total deposit. So this is actually a target for most of the bankers. You have to maintain good CASA ratio. CASA is current account saving account divided by total deposits. So the higher ratio, the higher the CASA is, the better would be the yield of the bank. Then we can have profitability ratios. Then we can have profitability. In profitability, we can have return on average asset pre-tax. Then we can have return on average equity pre-tax, right? This is the return earned on equity. This is the return earned on assets, right? So this is the real return that the bank is earning, right? By investing their or by having their equity, right? Then we can have operating profit to average asset, that is we can calculate this kind of a ratio. Then we can also have total income to total average assets, how much you are generating income from your total asset, how much you are generating income or profit from the average asset, how much you are generating income from the average asset, how much is the net non-interest income to total income. This is a very good ratio. That is non-interest income to total income, right? Because non-interest income, banks are mostly concentrating now on these areas, right? Because funded is something which is vulnerable for NPL as well, which is vulnerable for interest rate fluctuation as well, which is dependent on the credit history of the customer, which is dependent on the future of the customer. You see, so banks are mostly moving their channels, they're extending their channels, right, to earn more business. And non-interest income to total income, then we can have operating expenses to total to average asset, right? Then we can have loan loss provisioning, right? How much expense to operating profit. Loan loss provisioning means how much is your expense of how much is provision expense to operating profit, right? What is the PBT ratio, right? PBT against interest income, right? Gross yield on average earning asset, gross yield on average earning asset, right? So you can also take out the yield that we have calculated here for different things. If you will calculate all of them, if you will take the average of that, so that can be included in this slide. Then we can have cost to income ratio. This is a wonderful ratio. Cost to income is a very important ratio. Cost to income, because cost to income is something which banks are trying to monitor now, right? Okay, then we can have net operating margin. Then we can have asset utilization with us. Then we can have ROE, right? ROE is return on asset, ROE is return on equity. The formula is PBT upon equity, or PAT upon equity. I mean, for this is PAT upon total asset, PAT upon total equity. Okay, then we can also calculate per branch. What's the asset utilization? Asset utilization is basically fixed asset turnover. That is turnover upon fixed asset. Okay. What is per branch? Per branch is gross advances per branch. How much is your total advances and how much is your number of branches, right? So we have to divide it. So we can have gross advances per branch, and we can also have gross deposit per branch, right? These are the ratios which we can calculate, and this is a very good level of information, because if we take it from a trend point of view, if we have data, for example, last 5 years, so this is a good amount of information for the management, right? Then we can have PBT, PAT, number of branches, number of employees with us. Then we can also take a number of employees per branch. This is another way. Number of employees per branch, right? Number of employees per department, right? Number of employees per region. Banks are divided into different regions, different areas. So they can also take a look on that point of view. Then we can have share price history, right? And we can also take a trend of that. How much is the high of our shares? How much is the low of our share in the whole year, for example? Sorry. Or within a month, how much is the high? How much is the low? How much is the closing? What is the number of shares that we are trading? What is the shares turnover? And how much shares sold? How much shares bought? And we can also have market capitalization with us, and the top of it we can have a share price history. We can also have share price history as well, and share price history can also be taken. So this is what management accountant is supposed to do in the bank? Well, let me tell you, as I already told you in the start, management accountant is not something which is a area bounded thing. For example, learn these ratios, you are a management accountant. Learn these things, you are a management accountant. No, a management accountant can be expected to do any kind of analysis in the banks. And like for example, um, how much interest rate we are paying for the floater PIB. How much when are floater PIBs? PIBs are two kind. One is floater, that is having a floating rate, and then the others are fixed rate PIBs. So management do any kind of analysis, right? How much is the impact of 1 billion of financing on capital adequacy ratio? How much is the impact on 1 billion financing on the leverage ratio? How much is the impact of 1 billion financing on the NSFR, that is net stable funding ratio? I think it was here. This one, net stable funding ratio. You see, so bank can do these kind of analysis, though, because we need to understand one thing. For example, the regulatory requirement is 12% or 12.5%, and your car is, let's go, 13%. So all the impacts would be analyzed by the management before taking any kind of a decision, because you are at the edge of your regulatory requirement. Okay, so this is it. That's all from my side. If you have any question, please ask me from the
Thank you.
presentation if you ask anything. Yes.
There are questions piled up in the questions box, but I'll recommend everyone to please type in your questions. And if you have any questions from the previous session, please do type in those questions as well. So our first question is from Jawad Rahman. Jawad wants to know, can we have specific format of accounting for financial services? Is it available on the State Bank of Pakistan's website or elsewhere?
Yes.
I think he's talking about the format that we're demonstrating in the last session.
You see, we have covered this slide, if I'm not wrong. This is the format that we have done day before yesterday. This format is actually available on the State Bank website as well, because this is as per this, I think second schedule of the Banking Companies Ordinance, right? So this was issued in as per the circular of State Bank of Pakistan. I'll share the circular and the format, but this is the format. This is the bare format that we have discussed. This is not something which is originated by Tahir Taj. This is something which is given by State Bank of Pakistan. And what we have covered till the 63rd slide, if you remember, we have covered 63 slides in the last session. And all the slides are basically based on the State Bank format, because that's the best thing that I can do, that I can use for the sake of session, because this is the bare format, and that format will be required by everyone, or is required by the regulator. Yes, Firoz.
Thank you. Our next question is from Wakas Kazi. Wakas is asking why CDRs are still treated as current deposits, as opposite to other remittance instruments which are treated as liability.
Sorry, come again. I'm not getting you.
So the question is regarding CDRs.
CBR. What is CBR?
CDR. He hasn't written the full form. So I'll also request Wakas,
Customer
please.
depository receipt. Is it customer depository receipt?
I think we'll have to make guess
CDR.
on that.
Maybe, yeah.
Yes.
Mm-hmm.
Yes, CDR.
Why CDR is being treated as what?
Current deposits, as opposed to the remittance instruments which are treated as liabilities.
CDR is basically just like a pay order. There are a number of banks who are using CDR. Basically, it's a branch side thing and it's operations thing. So I'm not expert on the operation side. Very sorry, but what I have an idea, CDR is an alternate instrument to your pay order, right? And for example, if you are issuing a pay order, so you are actually using it on behalf of a customer. The deposit is no more from your deposit is gone from your branch, right? And it's an instrument unless and until it is credited by the other bank, it will be held in between, right? So it's my customer money. My customer money is my liability, right? So unless and until it will be credited in the other bank. So if it will be credited in another bank, it will be a liability or of another bank. But as far as my balance sheet is concerned, it has to be in the balance. It has to be in the liability side because this is something my deposit money, right? But since it's not credited by my, it's not out from my account, so I'll treat it as mine, right? Unless and until um, it has gone to somewhere else. Yes, but definitely. But just a minute. If it is excluded from my bank account, from my customer account, so why should I take the liability? I'll not take the liability. It's a wrong thing if the bank is taking it. If it is available with the bank, if it is not yet dispatched, if it is held with the bank, then I should treat it. Otherwise, I should exclude it from my customer's bank account. Why should I treat the liability? It's a wrong treatment if someone is doing. Yes.
I think we have answered the questions. Let's just give it 1 or 2 minutes. If we receive any questions, then we'll answer them. If not, we'll wrap up the session. Guys, if you have any question for Mr. Tahir, please type in your questions so I can revert that to an answer. If not any question, do you guys have any feedback for Mr. Tahir? Mohammed Altaf is asking, can you share the format of the finances? I think Altaf, you can download that from State Bank's website. Is that correct,
No,
Mr. Tahir?
it's not an issue. Firoz, we can share the format. And I have shared the last presentation format and I'll be sharing this one as well. So you can send to the participant. There's no issue on that. I don't have an issue. You can share it. Knowledge is something which should be available to everyone, and I would prefer to have these kind of formats with you so that you can have an expertise on that. You can capitalize on that. That's a good thing that we should learn. Yes. Anything else?
Jawad Rahman is saying, thanks for the session, very informative. Mohammed Altaf is saying, thanks as well. I'm glad you guys liked the session. Quite a dry topic in my opinion, but I think we covered it well, and that too in time. So I think that's it. We are not receiving any questions. I think let's just wrap it up. Thank you so much, Mr. Taya, for your time, for
Yeah,
all the
it was
knowledge
awesome.
that you share that for the knowledge that you have shared with us, and uh, I hope to have such sessions with you in future as well, and I hope
Sure.
our members are having the same feeling as both of us. So thank you so much
Sure.
for your time,
Thank you so much.
and
Thank you so much.
if you want to add anything, please go ahead.
Uh, I would like to say thank you so much to everyone for attending this session. Uh, this is one of the good initiative of ACC Pakistan, and It was a brainchild of the MNP, in which I'm a vice chair as well. And this idea was floated, I believe, last years back. But the way we are now doing it, it's a wonderful effort, and the participant, I mean, the level of participation is really appreciable, and it's a wonderful thing. The reason being, you cannot find out these kind of specific industry specific formats or industry specific lectures or seminars on that. Thank you so much.
Mr. Tired, indeed, quite informative sessions. One of our participants is saying that amazing sessions, but at a very fast pace. That is correct, Mohammad Ijaz. And the reason is we labeled these sessions as short certification courses, was to cover as much information or as much knowledge as we can. That is essential for the members working in the BFSI sector. We have made it a bit fast paced, so the interest is intact, and we don't lose any interest during the session. So thank you so much, everyone, for joining us in today's session. The next session, this is also an announcement. The next session would be on Saturday, because the trainer requested he won't be available after working hours. So we moved that session on a weekend, that is Saturday coming 29th October. The session would be from 3 to 5. We might have discussed this before in the previous sessions as well, where I did ask the participants what would be suitable time for a session on the weekend. So see you guys on the weekend. And the topic for the next session is regarding the lending products, risks, and operations. So see you guys all on Saturday. I'll drop in a text in the WhatsApp group as well, so you guys have a reminder for that as well. Thank you so much, and wish you all a very good week ahead, and see you next time. Goodbye.